Welcome to the financial food chain of 2025. While everyone was busy watching crypto memes, the traditional brokerage giants were quietly re-engineering the global plumbing of wealth. We're moving from a buy-and-hold era to a divergent and conquer epoch. Think of this as the Avengers, endgame for investment banks, but with more spreadsheets and fewer capes. Today, we dissect how the US, China, and Korea are essentially playing three different sports on the same field. Let's talk about the $4 trillion elephant in the room. That's enough liquidity to buy a Tesla for every single resident of New York City and still have change for a trip to Mars. But here's the complication. Having a massive balance sheet is like having a heavy suit of armor. It's great for protection, but if you can't move, you're just an expensive statue. The global brokerage model is undergoing a radical weight loss program, shifting from capital-heavy risks to asset-light agility. The ROE gap is widening faster than the social distance at a billionaire's gala. On one end, we see a 16.6% return. On the other, a 7.9% struggle. In the world of high finance, efficiency isn't just a metric. It's the difference between being the shark or being the plankton. If your ROE is below 10% in this environment, you're not a financial powerhouse. You're basically an oversized, low-interest savings account with a fancy lobby. The world has decoupled, and everyone has a different survival settings file. The US is going asset-light, prioritizing fees over risk. They'd rather be the landlord than the tenant. China is going functional, treating investment banks as the high-pressure fuel pumps for their new quality productive forces. And Korea? They're going global digital, turning stock trading into a 24/7 mobile game that's more addictive than TikTok. It's like a specialized RPG where everyone is maxing out different skill trees. When we look at Goldman and Morgan Stanley, the profit lead is so massive it's almost rude. They're generating 4 times the net income of their closest global rivals. While others are grinding for XP in local markets, these two have already unlocked the infinite money glitch known as fee-based resilience. In short, they've moved from eating what they kill to collecting rent from the entire jungle. Morgan Stanley has built a moat so deep, even a professional diver couldn't find the bottom. 45% of their revenue now comes from wealth management. This isn't just a business line. It's a shock absorber for the soul. When the markets crash, trading desks cry, but wealth management just keeps collecting those 31 basis points. It's the financial equivalent of owning the only umbrella shop in a city where it's always raining. Goldman Sachs finally stopped trying to be everyone's favorite neighborhood app and went back to being the Vatican of finance. By divesting from consumer tech and returning to M&A and alt investments, they've seen a 15% ROE recovery. They realized that trying to do retail banking was like a Michelin star chef trying to run a Taco Bell. Noble, but ultimately a waste of talent. Now they're focused on that $750 billion alt AUM target, like a heat-seeking missile. In China, the game isn't just about the P&L, it's about the impact and infrastructure. CITIC isn't just a broker, it's the financial engineer for China's hard tech sovereignty. While Western firms chase the next SaaS startup, CITIC is underwriting the future of semiconductors and robotics. They are the #1 IPO machine for the new quality productive forces. If the tech race is a gold rush, CITIC is the guy selling the most sophisticated shovels in the world. The CITIC CLSA ecosystem is a closed-loop value machine. They invest early, they underwrite the IPO, and then they provide the global secondary market coverage. It's a cradle-to-grave strategy for unicorns. By integrating PEVC directly with investment banking, they ensure that no value leaks out of the system. It's the ultimate, full-stack approach to finance, like owning the farm, the grocery store, and the restaurant. Korea's brokerage strategy is basically finance on caffeine. Mirae Asset is currently conquering India, acquiring millions of retail clients faster than a viral dance trend. Meanwhile, CITIC Securities is playing the Veblen game, focusing on UHNWIs with the precision of a luxury watchmaker. They've turned the smartphone into a terminal for global wealth, proving that if you give people a slick UI, they'll trade their way through a recession just for the dopamine. Let's look at the efficiency Olympics. Goldman Sachs makes $1.2 million per employee, which is impressive, but look at Mirae Asset's RPE. Because of their insane digital leverage, their revenue per employee reflects a level of automation that would make a Silicon Valley engineer sweat. Korean firms have the highest operating leverage globally. They are essentially running a global bank with the headcount of a mid-sized suburban high school. For the bears in the room, everyone's capital buffers are thicker than a winter coat in Siberia. With a 210% risk coverage average, these firms aren't just surviving, they're fortified. CITIC and GS have enough capital in the basement to survive a black swan event and still have enough left over to buy the swan. We're looking at a fortress balance sheet era, where volatility is seen as an opportunity, not a threat. Sales and trading is where the alpha hides. Whether it's the GS Marquee platform or CITIC's OTC dominance, these firms are the house in the global casino. They don't bet on the red or black, they own the table. CITIC's OTC notionals hitting $196 billion tells you one thing. When the world wants to hedge, they have to pay the toll to these gatekeepers. It's a beautiful, high-margin, sticky ecosystem. Looking ahead to 2026, the roadmap is clear. Q1 is for spring cleaning, divesting risky assets. Q2 is the AI arms race, using LLMs to predict who's going to move their money before they even know it. By Q4, expect a wave of slow market acquisitions. The giants will swallow the boutique players who couldn't keep up with the tech spend. The big will get bigger, and the digital will get smarter. Adapt or be acquired. There is no third option. Strategy isn't about having all the answers. It's about asking the right questions before your competitors do. If you want the full-page data dump behind this deck or a bespoke research deep dive for your firm, you know where to find us. Drop a comment below on which region you think will win 2026. Send an email to sales@hdinresearch.com for the full PDF, and follow at HDIN230 for more financial autopsies. The alpha is out there. Go get it.